I want you to just try and imagine this for a second. Um, Picture the absolute peak of Japan's economic miracle. We're talking late 1980s.
Like the ultimate boom era.
Exactly. And during this peak, the dirt, like the literal physical dirt sitting directly underneath the Imperial Palace in Tokyo, was valued higher than all the real estate in the entire state of California combined.
It is still one of the most insane statistics in financial history.
I mean, it just breaks your brain a little bit, right? You just sit with that metric. A single palace compound in Tokyo dwarfed the entirety of Silicon Valley, Los Angeles, basically every inch of the California coastline.
Yeah.
And the wild part is today, the downstream consequences of that exact same Japanese economy are actively threatening the foundation of your 401k, the mortgage rate you can get on a house, and honestly, just the structural integrity of the entire global financial system.
Yeah, I know it sounds incredibly hyperbolic to connect 1980s Tokyo real estate to, your local mortgage rate today. But the causal chain is actually incredibly direct. I mean, we all operate under this comforting illusion that our domestic financial realities are built on local bedrock,
Like, we assume the stock market is just doing well because American companies are crushing it.
Exactly.
Yeah.
We assume the S&P 500 or the local housing market is purely a reflection of domestic consumer demand. But the reality is that a massive chunk of global market liquidity has been quietly supported by trillions of dollars of borrowed Japanese money.
Trillions.
Trillions, continuously flowing outward into the world for over 3 decades.
And that silent pipeline of money is currently cracking, which is the entire focus of our deep dive today. So to really get into the weeds on this, we are pulling from an incredibly detailed stack of sources.
Yeah, we've got some great material to work with.
We really do. We're looking at a super comprehensive macroeconomic analysis that was originally spearheaded by financial content creator Andre Geek. He basically breaks down the specific architecture of this whole system.
Right, the actual plumbing of how the money moves.
Yeah, exactly. And we were pairing that with some really critical commentary and kind of psychological overlays provided by entrepreneur Tom Bilyeu.
So the mission for this deep dive is to just completely demystify this mechanism for you.
Yeah.
We need to unpack how a financial strategy known as the yen carry trade became this silent engine behind global growth.
Right.
And why the macroeconomic events of the past few years have pushed that 30-year system to the breaking point. And obviously what that inevitable unwind means for your personal wallet.
Okay, let's unpack this. But actually, before we really get into the mechanics of the yen carry trade, I do need to address a specific element of our source material right up front.
Oh, right, the pandemic commentary.
Yeah. So in his analysis, Tom Bilyeu provides some pretty blistering critiques of global pandemic responses. He specifically characterizes government economic shutdowns as, and I'm quoting here, moronic and cataclysmic.
Strong words for sure.
Very strong. So to be crystal clear, we are simply mapping out his argument regarding how those specific shutdown policies disrupted global supply chains and sparked the economic chain reaction we're discussing today.
Right, we're just looking at the math.
Exactly. We are entirely focused on tracing the financial cause and effect within the macroeconomic plumbing. We are absolutely not endorsing or debating the political or social viewpoints surrounding COVID mitigation strategies.
Yeah, we're just strictly isolating the financial variables here.
Right.
And honestly, the very first variable we have to isolate is the psychological anomaly of the Japanese economy itself. Because Western economic frameworks often just completely fail when you apply them to Japan.
Really? Why is that?
Because the behavioral incentives are entirely different. The culture reacts to money differently.
Which I guess brings us right back to that Imperial Palace statistic.
Yeah, perfectly sets the stage.
Because the 1980s in Japan was just an era of unprecedented euphoria. Like they had built this industrial and technological juggernaut out of the ashes of World War II. Capital was just completely flooding into real estate and these massive corporate conglomerates.
But you know how it goes? Asset valuations that become completely untethered from actual underlying yield eventually snap back to reality.
They always do. And in 1989, the bubble spectacularly popped.
It was brutal. Yeah. And the key thing to understand here is that it wasn't just a standard cyclical recession, like a couple of bad quarters and then you bounce back.
Right.
The 1989 crash induced a 30-year period of severe deflation. Prices stagnated, wages completely flatlined, and the fundamental velocity of money, like how fast money moves through the economy, it just ground to an absolute halt.
So how does the government even respond to that?
Well, in a desperate bid to fight this economic freeze, the Bank of Japan, the BOJ, executed a policy that seemed pretty radical at the time, but it ended up becoming their permanent reality.
Which was?
They dropped interest rates to essentially zero.
Wow, and they just left them there.
Left them at zero for 3 entire decades.
Okay, so I have to stop you there because if you look at literally any standard macro while simultaneously running up a massive national debt, that should be a recipe for total currency destruction.
Right. It sounds like economic suicide.
It really does. I mean, Japan currently holds a debt to GDP ratio of over 200%. And just for some context for you guys listening, when Greece experienced its catastrophic sovereign debt crisis, its debt to GDP was significantly lower than that.
Much slower, yeah.
And Argentina's multiple defaults, those happen at even lower thresholds.
This is exactly the paradox that completely baffles casual observers.
Yeah.
For traditional metrics, a nation carrying over 200% debt to GDP, while literally lending money out at 0%, they should have experienced domestic hyperinflation and a total currency collapse like decades ago.
So I have to challenge the premise here. If you have a central bank basically giving money away for free and a government just accumulating debt at a historic scale, how on earth did they avoid turning into Weimar Germany? Like, where is all the inflation?
Yeah, it's a great question. And the answer lies in the architecture of their balance sheet. It's not just about the aggregate volume of the debt. It is deeply, deeply dependent on the identity of the creditors.
Okay, so who actually owns the debt?
Exactly. Think about the sovereign debt crises in Greece or Argentina. Those governments owed massive sums of money to foreign entities.
Right, like international bondholders, foreign banks, global institutions.
Yeah. And when structural weakness appears in your economy, those foreign creditors have absolutely zero loyalty to your domestic stability. They panic, they dump the bonds, and that triggers massive capital flight.
So the currency collapses because everyone is just rushing for the exit at the exact same time.
But Japan's exit doors look completely different.
How so?
They're essentially locked from the inside.
Yeah.
Japan owes that 200% debt to itself.
Wait, to itself?
Yeah. It operates as this closed financial loop. The Bank of Japan currently holds roughly 48% of its own government debt.
You're kidding. So the central bank is literally just buying the bonds issued by its own government?
Yep. And it goes further. Domestic Japanese insurance companies hold another 20%, and domestic Japanese banks hold around 14%. Foreign investors, the ones who would panic and run, they account for less than 8% of the total holdings.
Okay, so if the vast majority of the debt is held by domestic institutions that are basically tethered to the survival of the state, the risk of a sudden panic-driven sell-off is drastically reduced.
Exactly. The system is rigged to hold itself up.
But that still doesn't fully explain the lack of inflation to me. Because even if the debt is domestic, pumping that much liquidity into the system to buy those bonds, that should still devalue the currency locally, shouldn't it?
Well, that assumes the Bank of Japan was matching its low interest rates with aggressive quantitative easing.
Like wildly printing new money to flood the streets.
Right. But the data from our sources reveals a very, very different reality. Listen to this.
Yeah.
Since 2004, the U.S. money supply expanded by roughly 280%.
Okay.
Canada's money supply grew by an astonishing 370%.
Wow.
But over that exact same time frame, Japan's money supply only grew by 90%.
Oh, wow. So money actually remained relatively scarce within their own borders, even though the cost of borrowing it was functionally zero.
Which points directly back to the behavioral psychology of the population that we mentioned earlier. Tom Bellew uses this brilliant mechanical analogy in the source material.
Oh, the stove analogy.
Yeah. He describes the 1989 crash as an entire culture getting its hand burned on a hot stove. The trauma of that wealth destruction completely rewired their risk tolerance.
I mean, it makes sense. If you lose everything, you're not going to be eager to jump back into the market.
Exactly. Investors and corporations became obsessed with deleveraging. They just wanted to pay down their existing debt rather than taking on new loans to fund any kind of expansion.
So even with money sitting there available at 0%, domestic demand for borrowing was just non-existent.
Right, because the fear of another crash heavily outweighed the potential for any growth.
So you basically have an entire population terrified of risk, just hoarding cash, and completely refusing to spend recklessly at home. But, and this is the big question, those individuals still have savings accounts.
Right.
They are still paying into their pensions every month. They're still paying life insurance premiums. Those massive pools of institutional capital cannot just sit in a vault earning literally 0%.
They absolutely can't. Those institutions have a fiduciary duty to generate yield to support an aging demographic.
Right, they have to pay out retirements eventually.
Exactly. What's fascinating here is that if the domestic environment offers zero yield and zero growth, that capital has no choice but to seek returns elsewhere. The psychological trauma at home literally forced the capital to look outward.
And that outward migration of capital is the foundation of the yen carry trade. This is the specific macroeconomic plumbing that connects the Bank of Japan directly to your local asset prices.
It is. And to really understand the sheer scale of the yen carry trade, we have to look at the mechanics of institutional arbitrage.
Let's define that real quick for anyone who isn't familiar. Arbitrage is basically exploiting the price difference of an asset in two different markets, right?
Precisely. And in this case, the asset they are arbitraging is capital itself.
Okay, let's actually map out a hypothetical institutional trade to see how this works in practice. Walk me through it.
Okay, so imagine you're a massive global hedge fund. You approach a Japanese financial institution and you borrow 1 billion Japanese yen.
A billion yen. Got it.
Now, because the BOJ has anchored rates at the absolute floor, the interest on that billion yen loan is effectively 0%. It is structurally free capital.
Which is just wild to think about.
Right. So the hedge fund immediately takes that billion yen, converts it into US dollars on the foreign exchange market, and deploys those dollars into assets that actually generate a real return.
And historically, the safest and most liquid asset to park that kind of massive money in has been U.S. Treasury bonds.
Exactly. So if a U.S. Treasury is yielding 4% or 5%, the hedge fund is basically executing a masterclass in risk-free profit.
Because they're paying 0% on the liability side of their ledger, but they're collecting 5% on the asset side.
And they just pocket the spread.
Wow.
Now, I want you to multiply that dynamic by trillions of dollars over the course of 3 decades.
It's almost unimaginable scale.
And the crucial element here is that it wasn't just aggressive Western hedge funds executing this trade. The domestic Japanese institutions, the exact same ones we mentioned holding all that government debt, they were doing the exact same thing to find yield.
Like the pension funds.
Exactly. The Japanese Government Pension Investment Fund, or the GPIF. They are literally the largest pension fund on the planet. To ensure they can actually pay out retirements to this massive aging society, they took their domestic capital, converted it, and bought hundreds of billions of dollars worth of U.S. bonds, American tech stocks, global real estate, you name it.
Okay, here's where it gets really interesting for the listener. Through this relentless, persistent outward flow of capital, Japan quietly became the single largest foreign holder of U.S. government debt in the entire world. They hold over $1 trillion in U.S. treasuries.
And this right here is the missing piece of the inflation puzzle we discussed earlier.
Oh, right. How they avoided Weimar Germany levels of inflation.
Exactly. The reason Japan didn't experience domestic inflation despite a 0% interest rate environment is that they actively exported it.
Let's break that down mechanically. How do you export inflation?
Well, typically, if borrowing costs are zero, businesses and consumers take out loans and they spend that money locally, you have this massive influx of currency chasing a static supply of local goods and services.
Which forces local prices upward.
Right. But in Japan's case, the borrowed money immediately left the domestic ecosystem. The yen was borrowed, converted, and used to bid up the prices of assets in New York, in London, in Silicon Valley.
So the inflationary pressure was applied to the global financial system, not the local Japanese economy.
Precisely. So when we look at the relentless bull market in U.S. equities over the 2010s, or the ease with which the U.S. government financed its massive deficit spending, or even the explosive liquidity that fueled speculative assets like Bitcoin, a significant, completely invisible portion of that buying pressure was simply Japanese capital frantically searching for yield.
So it was basically a perfectly symbiotic, but incredibly fragile global arrangement.
Very fragile. But yes, for a long time, everybody won. The world got access to a seemingly infinite pool of cheap liquidity to drive asset prices higher and higher. And Japan was able to sustain a 200% debt-to-GDP ratio without destroying its domestic pricing stability.
But the entire architecture of this arrangement rests on a single massive load-bearing pillar. Japanese interest rates must remain at zero in perpetuity, because if the cost of borrowing that yen ever increases, the mathematical spread that makes that entire arbitrage profitable just collapses.
And unfortunately for this system, the macroeconomic shockwave that ultimately fractured that pillar was the global response to the COVID-19 pandemic in 2020.
Right. The source material focuses pretty intensely on the supply and demand mechanics of that specific era, because governments worldwide mandated these economic shutdowns, which effectively froze the entire global supply chain.
It was unprecedented. Ships literally stopped moving, factories went totally idle, and the production of physical goods just plummeted globally.
But at the exact same time, to prevent a total collapse of consumer demand, governments simultaneously injected trillions of dollars of fiscal stimulus directly into their economies.
Right, so from a purely mechanical standpoint, you engineered a scenario where a historically massive influx of currency was suddenly chasing an artificially restricted supply of physical goods.
Which means math happens.
Exactly. The inevitable mathematical result is rampant global inflation.
And by 2022, that inflationary wave finally breached Japan's borders. For the first time in 30 years, Japanese core inflation hit and actually exceeded 2%.
Now, 2% might not sound like a lot to us. It's often the target baseline for Western central banks. But introducing 2% inflation into an economy that has literally operated on a baseline of absolute zero for 3 decades, that is a massive systemic shock.
Especially considering Japan's geographical reality, which just compounds the crisis exponentially.
Right, because Japan is a very resource-poor island nation. They are entirely dependent on imports for raw materials. And crucially, they import over 90% of their energy.
And global commodities, particularly crude oil and natural gas, are basically all priced and traded in US dollars.
Which creates a devastating mechanical trap for the Bank of Japan. Because as inflation surged globally, central banks like the US Federal Reserve took incredibly aggressive action.
Yeah, they did. The Fed hiked interest rates from near zero up to over 5% in a brutally fast tightening cycle, just trying to destroy demand and cool down prices.
But Japan couldn't follow suit.
They were just completely paralyzed.
Totally paralyzed. Because if the BOJ raised rates to match the Federal Reserve, they would instantly detonate their domestic bond market.
Because of that 200% debt to GDP ratio.
Exactly. When a government has that much debt, even a tiny fractional increase in the interest rate applied to that massive principal creates an astronomical debt servicing burden.
Basically, the entire tax revenue of the nation would be completely consumed just paying the interest on the debt.
Right. Rendering the government functionally insolvent overnight.
So they chose inaction. They kept their rates pinned to zero, essentially betting that global inflation was just a transitory supply chain hiccup that would kind of resolve itself before their currency broke.
But capital markets do not operate on hope. They operate strictly on yield differentials. I want you to put yourself in the position of an institutional capital allocator for a second. Okay, you can hold US dollars and secure a totally risk-free 5% return in treasury bills right now. Or you can hold Japanese yen and receive absolutely 0%.
The fiduciary mandate is pretty clear. You recklessly dump the yen and you buy the dollar.
And that mass capitulation is exactly what triggered the historic collapse of the Japanese currency.
The numbers are staggering. The yen plummeted from roughly 110 per US dollar down to 160.
It basically wiped out decades of currency strength in a flash, hitting a 40-year low.
Which feeds directly back into that energy crisis we were just talking about. Because if your currency has lost a third of its purchasing power against the dollar, the domestic cost of importing dollar-denominated oil just skyrockets.
It becomes incredibly expensive.
Right. It costs radically more yen just to keep the literal electrical grid functioning. And that dynamic imports even more inflation into the domestic economy, which then further devalues the currency, which makes the oil even more expensive.
It is an inescapable negative feedback loop.
So the Bank of Japan really found themselves staring down a genuinely impossible choice, like a vicious crossroads where both paths basically lead to profound economic destruction.
Yeah, let's actually analyze the two options they had. Option 1, maintain 0% interest rates.
Okay.
This protects the sovereign bond market. It keeps the government's debt servicing costs manageable and prevents a technical default on the debt.
That's good so far.
But the cost of this path is the total sacrifice of the currency. The yen just continues to crater, imported inflation runs completely rampant, and the purchasing power of the population is basically incinerated.
So you are effectively wiping out the life savings of a nation of dedicated elderly savers through stealth inflation.
Exactly, and Bilyeu's analysis points out the historical precedent here. systematically destroying the wealth of the middle class through currency debasement that is the single most reliable historical catalyst for civil unrest and political revolution.
It never ends well.
No, it doesn't.
Yeah.
Which forces them to consider option two, raise interest rates to defend the currency.
Okay, so offering a higher yield would theoretically stop the capital flight and stabilize the yen, right?
Theoretically, yes.
Yeah.
But as we establish, raising rates instantly detonates the bond market. And because the BOJ itself owns nearly half of all outstanding government bonds, raising rates would inflict catastrophic mark-to-market losses on the central bank's own balance sheet.
It is the absolute definition of a catch-22.
It really is.
But before we look at how they actually tried to navigate this mess, we have to look at how option one, all that imported inflation, has already fundamentally altered the cultural psychology of Japan.
Right. Because remember that hand-on-the-stove mentality from 1989?
Yeah. For 30 years, Japanese workers simply did not demand pay raises.
It is so difficult for Westerners to conceptualize that. But think about it. If a bowl of ramen, a train ticket, and your rent cost the exact same amount in 2020 as they did in 1995, your purchasing power is perfectly stable.
So in a rigidly deflationary environment, agitating for a higher nominal salary isn't just culturally discouraged. It literally lacks economic necessity. You don't need a raise if prices never go up.
Exactly. But the collapse of the yen completely shattered that stasis. Because food and energy are imported, the prices in Tokyo supermarkets are suddenly soaring.
Right. The math of daily survival changed.
The psychology shifted almost overnight. Workers looked at their depreciating yen and realized their static salaries could no longer cover basic survival. So for the first time in an entire generation, Japanese labor unions aggressively demanded structural wage increases.
And the crazy part is the corporations facing the exact same inflationary pressures they actually conceded. Japan is currently seeing the most significant wage growth in over 3 decades.
So from a macroeconomic perspective, what does that actually mean?
It means they have crossed the Rubicon. Once a wage price spiral begins, where workers demand more money to pay for higher prices, and then companies have to raise prices even further to cover those higher wages, it is nearly impossible for a central bank to suppress it without inducing a severe recession.
The psychology of the entire nation has definitively transitioned from expecting flat prices to expecting perpetual inflation.
So recognizing that they were completely losing control of the narrative, the Bank of Japan and the Ministry of Finance attempted to engineer an option 3.
Oh yeah. They tried to intervene in the markets without actually fixing the underlying structural rot.
And their defense was spectacularly botched.
It was a disaster. They basically attempted to fight macroeconomic gravity with sheer brute force. In the spring of 2024, the Japanese Ministry of Finance authorized a direct currency intervention.
Let's break down the mechanics of a currency intervention for a second, because it's not just like they issued a stern press release.
No. A direct intervention means the government literally steps into the open foreign exchange market. Japan took its massive reserves of US dollars, went into the open market, and aggressively brought their own currency, the yen.
And the goal there is just to artificially manufacture massive buying pressure, right? To drive the price of the yen up and basically scare off all the hedge funds and speculators who are betting against it.
Exactly. And they deployed an astonishing $73 billion in this singular effort.
Oh, wait, sorry, $73 billion. With a B.
With a B. $73 billion of foreign reserves just fired straight into the market.
So what was the net result of all that cash?
It altered the trajectory for exactly 3 weeks.
3 weeks? Wow.
Yeah. The yen spiked temporarily. The market completely absorbed the $73 billion of liquidity, and then the currency immediately resumed its collapse.
Because you cannot plug a structural hole in a dam with just a bucket of cash?
You can't. The yield differential between the U.S. and Japan was simply too massive. The global market gladly took the other side of Japan's trade and just swallowed that $73 billion.
So realizing that direct intervention was a catastrophic waste of foreign reserves, the Bank of Japan finally capitulated. They touched the forbidden dial. They initiated their first rate hikes in decades.
But they were so terrified of blowing up the bond market that they moved in these microscopic increments. They ended the era of negative rates and eventually bumped the policy rate to around 0.25%. And later, they signaled moves toward 1%.
Now, logical deduction suggests that if a central bank raises interest rates, they are offering a better yield to investors. So that should increase demand for the currency and increase demand for the bonds, right?
That is what the textbooks say. But the exact opposite happened. The yen continued to struggle, and their bond yields violently spiked, which means the price of their bonds was crashing.
Right.
The yield on the Japanese 10-year bond multiplied by 10 in just 4 years, and the 30-year bond yield hit 4%.
And simultaneously, the Japanese stock market experienced severe turbulence. So why did a rate hike cause demand for their debt to just completely vanish?
This is a phenomenal mechanical concept known as the waiting game paradox.
Hmm.
To really understand it, we have to look at the inverse relationship between bond yields and bond prices on the secondary market.
Okay, let's unpack that.
Let's assume you are a major institutional portfolio manager.
Okay.
The BOJ issues a 10-year government bond today that pays a 1% yield. But the central bank has also heavily signaled that this is just the beginning of a tightening cycle. They are basically communicating to the market that over the next 3 years, they will slowly, agonizingly raise rates to 2% and then maybe 3%.
Well, if I know for an absolute fact that the central bank is going to issue brand new bonds next year yielding 2%, I would be an absolute fool to lock my capital into a 1% bond today.
Exactly. Why buy now when the deal gets better tomorrow?
Yeah.
But it's actually worse than just missing out on future yield. It is about capital destruction. If you buy that 1% bond today for $100, and next year the government is offering 2% bonds, your 1% bond is now inherently less attractive to the broader market.
Right. Nobody wants my 1% bond if they can get a 2% one.
Precisely. So if you need to sell your 1% bond to another investor, they won't pay you $100 for it. They will demand a discount on the principal price until the effective yield of your discounted bond matches the new 2% market rate.
Wow. So by buying a bond at the beginning of a heavily telegraphed rate hike cycle, I am mathematically guaranteeing that the secondary market value of my asset will decline.
Which means institutional investors simply go on strike. They just sit on their massive piles of capital and completely refuse to participate in the bond auctions. They are playing the waiting game. They are waiting for the central bank to hit the absolute tippy top of the rate cycle before they deploy their cash.
So by attempting a slow, managed retreat from 0% rates, the Bank of Japan inadvertently obliterated the immediate demand for their own debt.
They did.
It perfectly aligns with that driving analogy presented in the sources. Attempting to manage an inflationary crisis with quarter-point rate hikes when your entire sovereign structure is addicted to 0% money, it's the equivalent of tapping the brakes while keeping your other foot mashed down on the gas pedal.
It's a great visual.
Yeah, you're just violently burning out the brake pads, the transmission is screaming, and the vehicle isn't actually slowing down at all.
And you have to remember, in the global financial markets, there are highly sophisticated institutional arbitrageurs who literally specialize in identifying these exact structural vulnerabilities.
Right, the sharks in the water.
Exactly. Global hedge funds looked at the BOJ's impossible math, they saw the failed interventions and the bond market buyers strike, and they recognized that the central bank was completely trapped.
So they went on the offensive. They started aggressively shorting the yen.
And the mechanics of shorting a sovereign currency on this scale are just fascinating. The data cited in the sources looks at the Commodity Futures Trading Commission, the CFTC. This agency tracks the positions of large institutions in the standardized futures markets. And the data revealed massive short positions against the yen. We're talking roughly 150,000 contracts, which represents somewhere between $11 and $12 billion in highly visible, regulated bets that the currency would continue to crash.
And as the analysis points out, CFTC data only captures the visible exchange-traded futures.
Precisely. The truly massive leverage exists in the over-the-counter or OTC derivatives market.
Right.
These are bespoke, private contracts written directly between megabanks and elite hedge funds. They are completely dark to public reporting until they literally blow up. So if there are $12 billion in visible shorts on the CFTC ledgers, the OTC market positions are likely magnitudes larger. The entire global smart money was uniformly betting against Japan's ability to defend its currency.
Okay, so we have established the perimeter of the trap here. The Bank of Japan cannot print their way out of this because of inflation. They cannot buy their way out with reserves because the macro tide is just way too strong. And raising rates just forces investors to wait on the sidelines while hedge funds circle the bleeding currency.
It's a very tight corner they've painted themselves into.
Very tight. So if all traditional market interventions have failed, what is the ultimate trump card? Like, How does a sovereign nation with the third largest economy in the world actually ensure its own survival?
Well, if you can no longer attract capital through the natural mechanics of yield and open market forces, you have to fundamentally change the rules of where money is allowed to live. You have to move away from persuasion and move toward coercion.
Wow.
This brings us to the overarching macro strategy of repatriation. Japan realized they must drag their immense offshore wealth back to the island.
Repatriation, basically the great unwinding of the yen carry trade, bringing all those trillions of dollars they spent 30 years exporting back home to prop up their domestic bond market.
Exactly. And the execution of this strategy began with some pretty heavy-handed government influence over domestic institutions. We discussed the GPIF earlier, that $1.8 trillion government pension fund.
Right.
In an incredibly blunt policy shift, the Japanese government publicly urged the GPIF to aggressively rebalance its portfolio. Specifically, they told them to stop buying foreign assets like U.S. Treasuries and start reallocating that massive capital pool into domestic Japanese bonds and equities.
I mean, it is essentially the government telling the pension managers, look, we acknowledge that U.S. yields are mathematically superior right now, but the sovereign state requires liquidity. You will buy our debt to stabilize the system.
And in Japanese corporate culture, a directive like that from the government sends a massive signal to the broader private sector. Private Japanese life insurance and casualty insurance companies observed the pressure being put on the GPIF and realized a systemic shift was occurring.
Right, they read the writing on the wall.
Yeah. These private insurers, who had been net sellers of Japanese long-term government bonds for years, due to the terrible yields, they abruptly reversed their behavior.
They didn't just stop selling. The sources note they suddenly became the largest buyers of Japanese domestic debt in recent history. They are literally sacrificing yield to act as a domestic firewall for the sovereign bond market.
But institutional pressure only goes so far,
Yeah.
which leads us into, honestly, the most fascinating, bizarre, and internet-fueled segment of our source material, the specter of absolute capital controls and the Udo tweets.
Okay, yes, let's set the stage for this because it honestly sounds like a financial thriller.
It really does.
So as the yen is collapsing and the BOJ is scrambling, a series of viral tweets begin surfacing from an entirely anonymous account operating under the handle Udo.
Right.
The account posts exclusively in Japanese, and it had steadily built this cult following as a cryptic market oracle, like an entity that seemingly possessed deep insider knowledge of the Bank of Japan's internal panic.
And the rhetoric used in these posts was incredibly theatrical. One highly circulated tweet offered, quote, deepest apologies to the citizens of Western nations, ominously claiming that the coming actions of the BOJ would negatively impact billions of lives globally.
Which is just wild. Another tweet stated flatly, and I quote, Japan's wealth is returning to its homeland by any means necessary.
By any means necessary.
Yeah, that specific phrasing is terrifying when applied to the plumbing of global finance because it implies the total abandonment of free market mechanics.
Exactly.
And then Udo dropped a highly specific legal reference that sent the financial corners of the internet into an absolute frenzy. They explicitly warned about something called Article 589.
And man, the internet narrative quickly mutated around this. People were suggesting that Article 589 was this dormant, secret legislative weapon that would allow the Japanese government to unilaterally seize foreign assets, forcibly liquidate offshore holdings, and physically trap capital inside the country.
Okay, but we need to apply some rigorous critical thinking here. Tom Bellew does an excellent job dissecting this rumor in the source material. I mean, it is super intoxicating to buy into a secret law conspiracy, especially when the macroeconomic math looks so grim.
Oh, for sure.
But when you actually audit the Japanese Civil Code, what is Article 589?
It is remarkably mundane. Article 589 of the Japanese Civil Code relates to relatively obscure contract law, specifically regarding standard pre-contracts and transportation agreements.
So it's not an authoritarian central bank super up and hidden in the Constitution?
Not even close. Bellew thoroughly discounts the specific Article 589 rumor as a classic internet nothing burger. It's just a piece of legal jargon weaponized to sound authoritative online.
However, Bellew makes a very crucial distinction here. While the specific legal citation of 589 might be total online fiction, the underlying systemic threat that the Udo account represents is entirely real.
This is the core of the repatriation thesis. If a sovereign nation is facing a catastrophic debt crisis and they cannot convince capital to return voluntarily through attractive interest rates, they absolutely retain the sovereign authority to become authoritarian.
Right.
A sovereign state controls the legal framework, They control the regulatory apparatus, and they hold the monopoly on force. They could easily implement draconian capital controls, legally barring domestic institutions from purchasing foreign assets or forcing the mandatory liquidation of offshore portfolios.
And that is the stick. The threat of top-down, authoritarian force to artificially manufacture demand for their own bonds.
But deploying the stick is messy. It terrifies global markets, it damages diplomatic relations, and it signals absolute total desperation.
Yeah, it's a bad look.
A terrible look. So before a government resorts to the stick, they will always attempt to engineer a highly innovative carrot.
And Japan's current carrot represents a wild, incredibly sophisticated pivot into the architecture of cryptocurrency.
Which is just, if you'd told me this a decade ago, I wouldn't have believed you.
Right. This is where the deep dive takes a turn that nobody would have predicted. Japan recently passed legislation referred to as the Clarity Act, which provides a robust, legally recognized framework for cryptocurrency as a legitimate financial asset.
Right.
And to incentivize offshore crypto wealth to repatriate, they are proposing massive tax cuts on digital asset gains, slashing the punitive 55% tax rate down to a flat 20%.
Now, a surface-level analysis of that might conclude that Japan is simply trying to foster tech innovation, or maybe cater to retail Bitcoin speculators.
Sure.
But the source analysis argues this has absolutely nothing to do with retail speculation. This is a highly calculated macroeconomic survival tactic designed to capture structural liquidity.
So to understand what Japan is actually building here, we have to look at how stablecoins operate right now in the United States.
This is the perfect mechanical parallel. Let's look at a massive stablecoin issuer like Tether, which manages the USDT token. The basic premise of a stablecoin is that one digital token is perpetually pegged to the value of $1. To maintain that peg and ensure trust, Tether takes the physical dollar provided by the user, and they have to park it in a highly liquid, incredibly safe asset.
So they don't just hold physical cash in a vault somewhere.
No. They take the user's dollar and they buy U.S. Treasury bills.
Ah. And if a treasury bill is yielding 5%, Tether collects that 5% yield on the billions of dollars of reserves they hold, while the crypto user simply gets the utility of using a stable digital dollar for trading.
Exactly. It's a wildly profitable business model for the stablecoin issuer. But from a macroeconomic perspective, what does it actually achieve for the U.S. government?
Well, it creates a massive structural captive buyer for U.S. debt. Tether is currently one of the largest single purchasers of U.S. Treasury bonds in the entire world, just constantly absorbing the debt the U.S. government issues.
And Japan is looking at the mechanics of Tether and realizing they can copy the blueprint. The Clarity Act and the accompanying legislative pushes are designed to pave a legal runway for the issuance of Japanese stablecoins.
But there is a catch.
A massive regulatory catch. The reserves backing these new digital yen tokens must be held in highly secure domestic assets.
Namely, Japanese government bonds, JGBs.
Japan is actively using cutting-edge blockchain legislation to legally manufacture a massive, captive new buyer for its bloated, structurally impaired government debt.
Wow.
By encouraging the creation of a domestic stablecoin ecosystem, every single time a user globally holds a digital yen, the issuer is legally mandated to buy a Japanese government bond to back it.
I mean, it is just a breathtaking synthesis of concepts when you step back and look at it. They are utilizing decentralized 21st century cryptographic architecture to artificially prop up a centralized 20th century sovereign debt crisis.
It's brilliant and terrifying.
They are literally trying to build a blockchain buyer of last resort so they don't have to resort to the authoritarian capital controls that Udo was hinting at.
If we connect this to the bigger picture, it really highlights the sheer scale of the desperation. When a G7 nation with one of the most established central banks in human history has to mimic offshore crypto mechanics just to prevent a bond market failure, you are witnessing a fundamental paradigm shift in monetary policy.
Yeah, it's unprecedented.
Yes.
So we have established the total picture of Japan's defense mechanism here. They are pressuring pension funds, they are threatening capital controls, and they are completely rewriting crypto legislation, all with a single unified goal.
Recall the trillions of dollars of Japanese capital that have been deployed globally for 30 years.
Okay, now we have to answer the ultimate question of this deep dive. What happens to the rest of the world?
This is the scary part.
Yeah. What happens to you, the listener, when the world's largest supplier of cheap liquidity suddenly packs its bags and leaves the global market?
Well, the global fallout is entirely mechanical, and the primary point of impact is the United States Treasury market. As we established, Japanese institutions are the single largest foreign holders of U.S. debt.
Right.
If the new mandate, whether it's through persuasion, stablecoin mechanics, or authoritarian mandate, is to aggressively purchase domestic Japanese assets, where do these institutions actually source the capital to do that?
I mean, they have to liquidate existing positions. They have to sell their foreign holding.
Exactly. They must sell their U.S. treasuries. The United States government is suddenly facing the reality of losing its most reliable, deep-pocketed, historical customer.
And isn't this happening at a really bad time for the U.S., too?
The worst possible time, because this is occurring at the exact same moment that China, historically the second largest foreign buyer of U.S. debt, has also been systematically dumping U.S. debt to decouple from the Western financial system.
Oh, man. So picture the U.S. Treasury holding a bond auction to fund the government's massive ongoing deficit. But their two absolute biggest VIP clients have permanently left the building.
And the scale of the problem is daunting. The U.S. doesn't merely have to finance its new deficit spending. It has to constantly refinance its existing maturing debt.
How much debt are we talking about?
The U.S. government currently has roughly $9 trillion in turnover debt that requires refinancing in the near term. $9 trillion. If the Japanese and Chinese bid is gone, how does the Treasury attract enough new capital to absorb $9 trillion of issuance?
I mean, the only mechanism available to attract new buyers is to sweeten the deal. You have to offer a higher yield.
Precisely. The U.S. government is forced to allow interest rates on its bonds to rise just to clear the market. And this is the exact mechanism that connects the Bank of Japan directly to your personal finances.
Right, this is where it hits home.
Because the yield on U.S. government bonds, specifically the 10-year Treasury note, serves as the foundational benchmark for almost all consumer borrowing costs in the United States.
So what does this all mean for you? It means that even if you possess zero knowledge of Asian macroeconomics, even if you do not own a single share of a Japanese corporation, your personal cost of living is directly tethered to Tokyo.
Absolutely.
If the U.S. 10-year Treasury yield spikes because Japanese institutions are liquidating their holdings, your local mortgage rates spike in tandem. The cost to finance a car increases. The interest rates on small business loans surge.
The entire American economy faces a systemic tightening of credit, solely because Japan recalled its capital.
And it creates a massive drag on domestic economic growth. But the bond market is honestly only half of the equation here. The global stock markets are equally, if not more, vulnerable to the repatriation unwind.
Oh, definitely.
Let's walk through the actual anatomy of an institutional unwind, because this is where the sheer violence of the yen carry trade really reveals itself.
All right, so we previously mapped out how the trade is built. Borrow yen at 0%, convert to dollars, buy assets like NVIDIA stock or U.S. treasuries.
But an arbitrage trade is fundamentally a leveraged position. When Japanese interest rates begin to rise and the yen begins to exhibit extreme volatility, the risk parameters of that trade are totally breached.
Yep. Portfolio managers get the tap on the shoulder from their risk departments, and they are forced to exit the position.
And the unwinding process is the exact inverse of the setup, and it creates a massive double impact on the markets.
Let's follow the capital. To close the trade, the hedge fund must first liquidate the U.S. asset. They sell their massive position in NVIDIA stock.
Right.
Now, when thousands of funds execute this simultaneously, it creates massive downward selling pressure on U.S. equities. The stock market plummets.
Okay, so now the fund holds U.S. dollars, but their original liability was denominated in Japanese yen.
Right. So to pay back the loan, they must take those dollars into the foreign exchange market and aggressively purchase yen.
And when a massive, incredibly crowded trade all rushes for the very same exit at the exact same time, the sudden astronomical surge in demand for the yen causes the value of the currency to violently spike upwards.
This mechanical unwinding process, selling global equities to frantically buy yen, is exactly why a sudden, aggressive spike in the value of the Japanese currency is the most reliable historical fingerprint of a global liquidity crisis.
It really is. The source material outlines a genuinely terrifying historical correlation here.
The track record is staggering. Let's trace the timeline of global market breaks. Let's look at 1998. The yen spiked roughly 15% against the dollar in a matter of days.
15% is a massive move for a sovereign currency.
Unheard of. And that violent currency move coincided directly with the catastrophic collapse of long-term capital management.
LTCM.
LTCM was a heavily leveraged mega hedge fund whose failure literally threatened to take down the entire global banking system. It ended up forcing an emergency bailout orchestrated by the Federal Reserve.
Okay, move forward to 2008, the Great Financial Crisis.
Throughout 2008, as the U.S. housing market was imploding and the banking sector was seizing up, the yen was surging relentlessly higher. Every leveraged carry trade on the planet was unwinding simultaneously as institutions desperately liquidated assets to cover their yen-denominated liabilities.
Fast forward again to March 2020, the onset of the COVID lockdowns. While the S&P 500 and global equities were in absolute free fall, experiencing unprecedented daily circuit breakers, the Japanese yen was once again spiking as global institutions aggressively deleveraged.
It's the ultimate canary in the coal mine.
And we don't even have to rely on deep history for this. We experienced a textbook flash crash version of this exact mechanism in August of 2024.
That was wild. So in August 2024, the Bank of Japan executed that minuscule rate hike we discussed earlier, just raising the policy rate to 0.25%, a tiny fractional adjustment.
Right.
But because the global market was so heavily over-leveraged on the assumption of 0% yen, that tiny hike triggered an immediate, panicked unwind of the carry trade.
And the results were instantaneous and violent. In a single trading session, the Japanese stock market plummeted 12%, which recorded its worst single day since the Black Monday crash of 1987.
The contagion immediately spread. U.S. equity markets sank violently in tandem as funds liquidated American stocks to cover their yen shorts.
Millions of retail investors watched the value of their 401ks gap down at the open, and the vast majority of them had absolutely no idea the carnage was engineered by a microscopic interest rate adjustment in Tokyo.
But here is the most crucial and, frankly, the most concerning distinction made in the entirety of this deep dive. The sources point out a fundamental shift in the nature of these crises.
Yeah, this is the scary part.
In 1998, in 2008, and in 2020, the yen spiking was an accidental byproduct. A crisis originated elsewhere in the system, investors panicked, they unwound their trades, and the yen went up as a symptom of the fear.
Right. But the paradigm has entirely flipped now.
It has. Today, a stronger repatriated yen is no longer an accidental symptom of a global crisis. It is the explicit, intentional goal of Japanese sovereign policy.
They're actively trying to trigger the exact mechanism that historically crashes global markets.
Exactly. Pressuring the pension funds, intervening in the currency markets, raising rates, laying the legal groundwork for JGB-backed stablecoins. Every single policy lever Japan is pulling is designed to drive the yen higher and force capital back on shore.
And they know what that means for the rest of us.
Of course they do. They fully recognize that unwinding the carry trade will drain global liquidity and cause massive volatility in Western asset prices.
But they are proceeding anyway because the systemic unwinding of global markets isn't a risk they are trying to avoid. It is simply the necessary collateral damage of their own sovereign survival strategy.
Japan is choosing self-preservation. And the bill for the last 30 years of cheap global liquidity is finally coming due.
Man. We have covered an immense amount of macroeconomic theory today. It is vital to just synthesize this journey to understand the full scope of the architecture.
Yeah, let's recap how we got here.
We started by examining the psychological scars of the 1989 economic collapse. That deep cultural trauma created a totally risk-averse society and forced the Bank of Japan to establish a 30-year environment of 0% interest rates.
Right. And because domestic yield was non-existent, Japanese institutions exported their capital. This birthed the yen carry trade, a mechanism that essentially pumped trillions of dollars of virtually free money into the global financial system.
And this invisible pipeline artificially inflated the valuations of U.S. equities, tech stocks, and government bonds, while uniquely allowing Japan to sustain a 200% debt-to-GDP ratio without triggering domestic hyperinflation.
But the architecture was fragile.
Right. The supply chain shocks of the COVID pandemic unleashed a wave of global inflation that eventually breached Japan's borders. Because they import their energy in U.S. dollars, the Bank of Japan was forced to import inflation, finally breaking the 30-year spell of stagnant prices and flat wages.
And cornered by that inflation, the BOJ found themselves trapped in that impossible paradox we talked about. Raise rates to defend the currency and risk detonating their sovereign bond market, or keep rates at zero and watch the yen collapse, completely impoverishing their citizens.
And their attempts to thread the needle through direct intervention and minuscule rate hikes failed, triggering that waiting game paradox that completely crushed immediate demand for their debt.
Which brings us to today. Recognizing that traditional market mechanics were failing, Japan moved to the endgame of repatriation.
Right. They're currently utilizing every tool available, from pressuring the massive GPIF pension fund to pioneering crypto stablecoin legislation designed to manufacture captive bond buyers to hovering the implicit threat of authoritarian capital controls over the market, all to drag their offshore wealth back to the island.
And the mechanical consequence of that repatriation is a structural withdrawal of liquidity from the West.
As Japan liquidates its foreign holdings, the U.S. Treasury is forced to offer higher yields to attract new buyers, which mathematically drives up the cost of mortgages and credit across the entire American economy.
Simultaneously, the unwinding of leveraged carry trades threatens the stability of global equities, as funds desperately sell Western assets to repurchase yen.
Which brings us to the ultimate foundational truth hidden beneath all of this complex financial plumbing.
Yeah. The core economic philosophy that Tom Bilyeu stresses in his commentary is that central planning has absolute mathematical limits.
Yeah.
You cannot infinitely manipulate markets without consequence.
Right.
Central banks possess the authority to print currency, they can artificially suppress interest rates, and they can construct elaborate, closed-loop balance sheets to delay the inevitable for a very, very long time.
But eventually, reality always catches up.
It always does.
Yeah.
Ultimately, a functioning economy requires a real, risk-adjusted rate of return. It requires tangible economic growth, productivity increases, and genuine value creation.
You cannot just engineer prosperity through debt ledgers. You have to be building real value in the physical world.
Exactly. And if a sovereign nation cannot generate real dynamic growth, capital will eventually identify the rot and attempt to flee. If a government responds by trying to trap that capital without offering real returns, they are inevitably forced to abandon free markets and resort to authoritarian coercive measures.
So the underlying disease in Japan isn't just a depreciating currency or a bloated bond market.
No, it is the fundamental lack of robust, risk-taking, dynamic economic growth over the last 30 years.
Wow. Which leaves us with a final thought I really want you, the listener, to mull over long after this deep dive ends. Let's look back at the Clarity Act for a second. We discussed Japan legally recognizing cryptocurrency, slashing capital gains taxes, and paving the legislative runway for stablecoins backed one-to-one by their own government bonds. Think about the immense historical weight of that specific policy pivot. If a sovereign nation, one of the G7, possessing the world's third largest economy and operating one of the most established, historically significant central banks in human history, finds itself so fundamentally trapped by its own debt that it has to resort to mimicking the mechanics of offshore crypto stablecoins just to artificially manufacture buyers for its own bonds.
It's wild to even say out loud.
What does that explicitly say about the future viability of traditional central banking as a whole?
It raises a profound systemic question about the absolute limits of fiat architecture.
Are we actively witnessing the slow, agonizing death of traditional monetary policy? Are we entering a new macroeconomic era where sovereign governments have accumulated so much unpayable, mathematically impossible debt that the traditional tools of statecraft, like interest rate manipulations and open market bond auctions, are simply broken beyond repair?
I mean, it certainly looks that way.
And if that is true, if the old system is terminally ill, does that mean that eventually decentralized technology and cryptographic code will be the only mechanisms left capable of stepping in to bail out the failing balance sheets of sovereign nation-states?
It is a staggering paradigm shift. It forces us to completely question the structural integrity of the bedrock we assume our entire financial reality is built upon.
Keep your eyes on Tokyo, because the economic tremors happening on that island right now are mathematically destined to shake the foundation beneath all of us.